Welcome to the Australian Property Podcast, helping you achieve success in property. Featuring your host, Jonathan Preston.
Hi guys, thanks very much for tuning back into the show. So in today's episode, I want to talk about where not to buy in 2017. Alright, let's get started. Alright, so I've been reading some commentators' views on, where sort of things are going and where people are buying, and interestingly, where not to buy in 2017. And thought I'd just talk about that in a bit of detail. I guess to get us started, consensus opinion is most certainly to avoid off the plan. That's something I've said from day one, and basically everyone's got a pretty similar reasoning for that, that when you buy it off the plan, you're sort of paying for that shiny new factor. The developers have certainly sold it for, the highest price they could possibly, get for it. They're in business, that makes sense. So you need to be realistic about the results you're going to get if you buy off the plan. Generally, if you're buying off the plan, you're going to end up in a high sort of density kind of, building. In most cases, most things being built now are obviously of significant density, and you are, very much speculating on the market. If we take a high density example, one of the things I'm seeing a lot of recently is people have bought in Docklands, valuations coming in very low, 10% below market. 10% below purchase price. So things purchased over 500k coming in, 460, 470, and these are 2 bedrooms. So this causes a lot of pain for people when it comes to actually getting the mortgage at the end. So that's something on that point, I guess, to expand further. There's 2 things here. So Melbourne inner city right now, I think, is a problem area. And a lot of the areas that are considered to be high density are really probably the areas you kind of want to avoid. So if we look, inner city, sort of Melbourne, one of the issues with that is that there are not only so many apartments being built, but they've been built with investors in mind. A lot of these being sold directly overseas, and to people not with the locals living there in mind. And that causes for a bit of an issue in terms of it's sort of like an artificial creation of supply. I mean, it's obviously not artificial, but it's not accurately meeting the demand of the people who actually want to live there. And so that's going to cause some further issues, and that's probably why we are seeing so much construction in terms of houses and the urban sprawl that's occurring in Melbourne right now, despite the fact that we've got so many apartments. And it's just because that is where the residents of Melbourne actually want to live. They prefer that as opposed to getting into what would be considered, I guess, well valued apartments in the city. So that's definitely something interesting. In terms of where the sort of density also causes issues, if we look at Brisbane, the inner city, demand is falling there and supply is rising with, new stuff being completed. The north side of Brisbane, sales activity is on the decline and rental vacancies are increasing. If we look at the Gold Coast, we've got a lot of high rises there. I've got some concerns around supply. Gold Coast market is known to be more volatile as well. If you're buying bottom end, old apartments, good yield, well, I definitely think you can make more of a case for that. But in terms of buying something that's pretty expensive and fancy, I don't know if I would be advocating that. The other thing is that the Gold Coast, it's got a modest economy. It's not really a big economy. And I do think that long term, the closer you're placed to a city that has a substantial economy, that's where you will see the greatest capital growth. In terms of like Perth, inner city, the economy there, while we have seen a bit of a pickup in mining, the economy is still pretty modest. and we do have an excess, amount of supply when it comes to new apartments. So that's something I would avoid as well. In terms of Sydney, high density areas are where I would prefer not to buy. And the reason being is basically you can only finance a smaller portion of these properties, generally up to 70%. And if, as an investor, the financeability of a property is kind of crucial to you being able to grow your portfolio, and you want to at least be able to go to 80%. So that's one of the concerns I have. Another being that they say that with the areas that are high density, there will be potential issues renting the properties out. Now, for the inner city high density areas, so I'm talking your kind of Zetlands, Rosary, Green Square kind of areas, that's a bit different. I mean, in terms of density and the 70% issue, that's still a big issue, and I don't love that. However, I do know of one significant investor who has basically all his holdings in those areas, and the rentability of his apartments is amazing. You get good tenants, you are well placed relative to the city, so one definitely can make a case for, despite the fact that they are high density and there is a lot of supply, there is actually a lot of demand in those areas too. An area, however, something like Parramatta, that concerns me more. As everyone on here would largely know, I have advocated, the investment of land value in Western Sydney for some time. But when it comes to Parramatta, I think we're seeing a density issue right now. There's a lot of apartments going up. And while we, refer to Parramatta as the second CBD, and I think as Sydney-siders, we largely think it's a necessary move, and it's probably inevitable that that's eventually going to happen as kind of a substantial thing. I wouldn't say it's there yet, and I'd say we're pretty far away from it being there. It's just not quite there yet, and there's a lot of apartments there, so I wouldn't buy in Parramatta, buying an apartment there. I think in other areas, there is more value. We've seen Western Sydney underperform recently after very strong performance in prior years where you were able to get good yields, and people made a lot of good returns in terms of the capital growth, and we've been able to stay positively geared through the high yield that we were able to obtain. So that was good. But we've seen in more recent times that it's been more the inner ring, so to speak, that has benefited from the capital growth, more due to that scarcity factor. And so that's something I expect it to continue in some ways over at least the next 2 quarters, just because we've got more demand than supply in these areas versus in Western Sydney. It is easier to buy, compared. And so right now, the other factor is, I guess, there is more supply coming online, I believe, in Western Sydney. That's pretty much, where all obviously like house and land and everything, pretty much you've got nowhere else to put it but to build out further west or southwest. But also in terms of apartments and everything, if you look at something like Parramatta, the amount of construction there is pretty amazing. So I think that's what you largely want to avoid. Now, one thing is, I would say, that is quite interesting is that I know there has become a secondary market for off-the-plan properties, and a secondary market, what I mean by that is where people have purchased a long time ago, property has increased in value over that time, let's say a suburb like Wentworth Point, and the person then has now got issues financing it at the settlement. Largely this is normally overseas buyers, and what they're doing is selling the property at below the bank valuation but still above what they paid for it. So let's say they traded the property, they bought a 2-bedroom for, let's just say 500 grand. Let's say it's worth 700 now. There's like a secondary market where, they might sell it for like 580 plus like 50k in cash. So your actual price is like 630, but in theory paying 630, bank val at 700, and Bankvale being conservative, being a high density area, and maybe if you were to put it on the open market, you might actually get over 700 for it. There may be opportunities there to arbitrage that. I know that exists. Right now, it's largely, I believe, between foreign investors that this is being traded between, because so many were told it was going to be easy for them to finance their properties going back a couple of years, and back then it was. But right now, it's become more difficult for them to finance these properties. Now, the other thing, I guess, on that point is that there have recently become more non-resident financing solutions. A lot of people have stepped into this arena. LVRs are still modest. You're still looking at 60 to 70 LVR, and you do still pay an elevated rate, but rates have suddenly come down from where they were. It should be possible to finance at 6.95 at around probably a 65 to 70 LVR depending, and that at least can give you time to settle on your property and then resell it if need be. So the market there is changing a bit, but I know that there is, or at least was, an active secondary market for high density particular apartments. But basically wanted to, I guess, just talk today about some of the areas that I wouldn't be rushing into, the areas that we do have concerns about, the areas that financing issues are occurring within, and basically going into this year, some of the areas you might want to think about avoiding basically. So really appreciate you tuning in. Thank you. Thanks for listening to today's episode. Please subscribe to the podcast, and if you've enjoyed the show, I'd really appreciate it if you could leave a review on iTunes and recommend the show to any friends that you think might benefit. Thanks again for listening, and we hope to see you back soon.